the watch list. I'm Nicole Petalides. We want to move to the world of ETFs. I was just talking about UFO, the space ETF. Now I'm going to talk to Barry Martin, portfolio manager for Shelton Capital Management, to talk about all kinds of ETFs. It's great to see you. And you recently launched a premium equity income ETF, SEPI. So why now? Why is it the right time for that particular ETF?
Yeah, well, thanks, Nicole, for having us on. It's nothing like the space ETF, but what we're doing in our ETF is we're selling covered calls, and we're different from other. I mean, this space, derivative income space, has grown dramatically. I think now, 5 years ago, it was roughly $1 billion of AUM. Now it's over $100 billion, and a lot of these ETFs that are coming to the market in the derivative income space are index level ETFs, meaning they're buying the S&P or buying the NASDAQ and selling index calls. What we're doing is we're buying individual calls, buying individual stocks while selling individual calls in its names. So we're active both on the underlying equity and with the option selling. So what we believe we're doing is buying the best stocks in the S&P 500 to sell covered calls on. And we're doing that to basically generate cash flow for clients and advisors.
And how are you avoiding some of the volatility or big swings in the market?
Yeah, I mean, so it's hard to avoid that, but what we're doing is we're monetizing that. So what we're doing is generating additional cash returns by monetizing the volatility of the underlying equities, and we do that by selling covered calls. So it's basically it's a way to dampen equity vol, and you can do that by selling covered calls, and typically it dampens volatility depending on what option strikes you're selling. But what we've noticed is anywhere from like maybe 25 to 30% is what we're doing. So we're taking advantage of volatility. And in this type of market where the VIX is in the high teens, low 20s is kind of like the best of both worlds for us, because we're able to sell covered calls that are out of the money while hitting our target of around 6 to 9%. And as we know, the market's been fairly healthy. So the market's gone up with higher volatility. So it's been really nice.
Understood. I mean, when you think about ETF solutions, what we did see was a record year for ETFs. Ooh, we have a lot of excitement here on Wall Street. We have our tree lighting tonight too, so there's a lot of folks around, a lot of exciting times
nice.
and people here. So let's talk about, when you think about the fund flows that we've been seeing, what have people wanted most, or where have you seen the most demand?
Yeah, it's really this income distribution cash flow market, and you're seeing, I think a lot of that has to do with demographics. We're seeing baby boomers in retirement, approaching retirement, that are looking for alternative ways to generate income, and that's where covered calls come into effect. You'll see some pretty high numbers in regards to cash flow distributions. We roughly stick into the 6 to 9% because what we're trying to do is balance the growth of the underlying equities while taking in some cash flow. So granted, you have older people using it for income and cash flow. Well, you have people like myself that are maybe looking for a risk mitigated strategy for owning equities. And like we mentioned earlier, it's a good way to lower volatility and still have your equity exposure.
So many folks used to go on the 60-40 plan.
Yeah.
How can you help them to do better?
Yeah, I mean, 60-40, there are periods in the market where it's done very well, but as we know, 2022, where correlations approach 1, fixed income and equities dropped dramatically. And so we're starting to see this type of strategy, which used to be a satellite, moving to the core. So we're seeing advisors take maybe 10% of 10% of the equity exposure and 10% of the fixed income exposure and creating a new slice of the pie. So we're seeing like a 50-30-20, with 20 being derivative income. And what that does, it lowers the overall risk for the portfolio because this has a different return pattern. These type of strategies do very well in choppy sideways markets, higher volatile markets. So these type of strategies take care of that. And so when you have 20% of your allocation set to that, it reduces one's overall risk. So you're seeing advisors really take advantage of that, and that's why it's moved from satellite to core.
And so at this point now, when we think about leverage ETFs, is there a place for that still?
That's a good question. We saw some notifications coming back. Like, we don't use any leverage in our in our portfolio, we're doing the basic covered call. And that's actually a very conservative approach. We're buying the stock and then selling someone the right to purchase that stock off of us at a predetermined price. Nothing's naked, and there's no leverage. Personally, myself, I get nervous with leverage, and I try and minimize that as much as possible. But I've been in the market for, not to date myself, but close to 30 years. And so, anytime you have blow up, leverage is involved, and so we stay away from that. We just go a conservative approach with option overlay strategies.
And what do you think, just before I let you go, what would you say is an investor misconception that you really want them to take away from here, Barry, today?
Yeah, I think the misconception, and I think we've gotten better at that with thanks to people like yourself and Schwab, is that options education. It's really changed over the last 20 years. People were really scared of options, but now you can really use them in one's portfolio to really risk mitigate risk and then enhance your cash flow or income needs. So I think that's the one key is education, and you guys do a great job of it. And I think we're seeing more and more people use options, and I think and you'll see it in the ETFs, but also on the individual side as well. So it's really become popular.
Barry Martin, portfolio manager for Shelton Capital Management, SEPI. Congratulations, and nice to speak with you today. Thank you.